Thanks, Grant. Julia Forrest is a portfolio manager at Pendal and specialises in REITs, which has been a fascinating sector in the last few months. Like everything on the market, we've seen some incredible moves. I was looking this morning at a few of the big retail REITs. They're up 50% since the market bottomed in March, but still down about 40% on the year. Julia, what are you sort of looking at or watching to make sense of what we've seen in the last few months?
Well, there is reason for optimism. We have seen a big recovery in retail sales, as the previous speakers have mentioned, in May. I guess we're trying to discern how much of it was pent-up demand, how much of it is supported by fiscal and monetary stimulus, and where it will be when it rolls off. But at the very worst of, I guess, the panic, in early April, I think Scentre Group's centres, only 39% of their retailers were open. They're well over 91, 92%, and for a number of the other big malls, it's even higher than that. So there is some reason for optimism. You know, there are a number of retailers that have actually done really well during this period. Retailers like JB Hi-Fi, obviously the supermarkets, you know, Adairs. We've all been sitting at home looking at our Daggy doona covers and been ordering online. So, you know, I guess to some extent you're going to see a reflection in a drop in turnover and a drop in rents between March and July. And we're looking at it as an opportunity for rents to be reset to sustainable levels. And once they're at sustainable levels, it will give us the confidence to put a higher multiple on those earnings as retailers and sales improve.
Yeah, and can you give us a little bit of an insight into how you've been sort of trading in terms of buying and selling through this period? Did you see that March fall as a chance to sort of you know, buy the dips as a lot of investors seem to have done around the world?
Well, I guess prior to COVID, retail sales had been fairly lacklustre. You know, wages growth had been fairly depressed. So we went into the downturn sort of with a fairly underweight position in the discretionary malls, tend to be overweight industrial, which, you know, benefits obviously from online. But, you know, the sell-off has enabled us to pick up stock at cheaper levels. Yeah, yeah.
Ian, I'd like to talk a little bit. Julia mentioned there that we have seen some really good performances from some of the retailers. JB's a great example, Adairs. And I guess what you're seeing, and of course, many in the Wesfarmers and Kmart stable as well, Catch Group's had a sensational period. Kmart sort of come back strongly. Bunnings and Officeworks have been great too. What we're seeing is this real omni-channel sort of approach that's been talked about for a long time. Really, you know, the rubber's hitting the road there. They're really starting to get that right. What's your sense of where we go to in terms of online sales? There's predictions now. I think the UBS prediction is we go from about 11% online sales, excluding food, to 17% by 2024, and then up towards 20%. What's your sense of where this settles? So obviously the online sales have spiked, but where do we settle?
Look, it's a great question, and I think it's one that we're all trying to figure out. And I don't think any of us have the magic answer. What we're assuming is there's a multi-year acceleration of the penetration of online sales in retail. Exactly what does that mean? Exactly what's that number going to be in the next 12, 24 months? I think a lot of that depends how this crisis plays out. And as we're seeing, it's quite unpredictable, as you know, with the Melbourne increase in cases this week, you know, being a case in point. You know, none of us really know quite how this is going to eventuate. So the way that we look at that, of course, is we've got to really make sure the combination of our retail stores and our online offer becomes even more compelling in combination, so that if a customer wants to shop in store or online, they get an equally good experience. And I think this is where online's really got to work hard, because we know that things like delivery times and delivery options in Australia still lag the rest of the world in many cases. So I think what you're going to see is not only an acceleration of online sales, I think you're going to see an acceleration of the improvement in the offer online, which is probably going to further accelerate it.
And in terms of what Kmart, Target, Catch Group are doing, you know, do you think you've quite got it right? And are there things that you've been able to, you're bringing across from Catch Group that inform what's happening at Kmart and Target?
Yeah, it's an area where we're putting a lot of investment into each of our businesses, including Catch, of course, as that business continues to grow at an incredible pace. Now, at times we've been ahead of the curve, at times we haven't. So, certainly within the Kmart business, we know there's so much more we can do with the way that we present our offer online to our customers to make that experience, a much stronger one. We're learning a lot from Catch. They are an incredible business with incredible knowledge. And when you combine that with the capability of Kmart and the rest of the Wesfarmers businesses, it's a really powerful combination, and certainly one that we're really trying to figure out how do we optimise.
We have the CEO of Catch on a little bit later too, so stay tuned for that. Grant, one of the things that Rob Murray from JB Hi-Fi told me a couple of weeks ago was that while online sales had gone very well during the intense part of the lockdown, once the restrictions were eased, the stores really bounced back very hard, and he was a little bit wary of calling the increase in online penetration until sort of the noise was out of the market. What are you seeing in terms of traffic and how that's changed, and whether we might see where we might see online and physical retail settling?
Yeah, it's a great question, James. Look, I think what Richard highlighted was really important, which is that the spike in online, it was actually quite phenomenal. It was 72% increase at the height of the crisis in March and April. That's come back to the historical average for online penetration. So just to be clear, by the way, that went to about close to a 20% number of total retail sales, a little bit under that. The number now is sort of somewhere hovering between 10 and 13%. Look, I think what it means is that retailers have to get smarter. Physical retailers have to get smarter about integrating an online proposition into their value proposition overall. And Ian's actually a great example of this, because if you look at our Chadstone Centre, for example, Catch.com have forward integrated into physical space. And I'll let Ian speak for his own business, but what we see from online retailers, which are pure online at a point in time, is that they really value the physical storefront, probably for two reasons. One is that, for the obvious reason, it just provides an additional sales channel. But two is logistically, it provides a solution for click and collect. And the big problem for a pure online play in Australia has really been because of the lack of urban density and the high delivery costs. It's quite uneconomic even today to actually deliver from a warehouse. So we believe that one of our roles going forward, in addition to being a showroom for goods generally, will be to provide, if you will, part of that logistical spine for the online provider through offering click and collect services.
Yeah, it's a great point. Ian, do you want to speak to what you're doing at Chadstone with Catch?
Yeah, well, at different times with Catch, we've brought, and this was done actually before we acquired the business by the previous owners, was we've had pop-up stores, and we've recently had one in High Point in Melbourne within the Target store. And it's a great way of exposing customers to the brand of Catch, because not everybody is aware of it to the same extent as Target and Kmart. And then, of course, it creates this real opportunity for click and collect, as Grant just called out. And we're now increasing that across our stores. And so very soon we'll be able to click and collect, Kmart, Target and Catch products from every one of our stores, whether it's a Kmart or a Target store.
Yeah, it's a great example of the omni-channel retail. Paul, I'll come to you with a question from our Slido, if I can. Why aren't we seeing any technology subsidies to help SME retailers get quickly onto e-commerce setups if they haven't been able to get there before? Which I guess goes to that point of, is this the time that retailers really need to knuckle down and get this right if they haven't managed to quite make it work before?
Sure. Look, I think it'd be fair to say that the majority of the larger retailers have actually, it's a journey, it's not a destination, I guess. So people are constantly working at improving their digital transformation, but largely the bigger retailers have kept up and have achieved that. I think when you look at the small to medium retailers, that's a different issue, because it takes cash to do these things. And I guess when you've got a business that actually, particularly during these times where we're dealing with unprecedented trading conditions, it's hard to justify to invest. So we are looking to government. There's been some great state initiatives that have been done at the state government level in investing with providing cash to do these things, but we're looking at better skills and training, but equally investment in small to medium business to digitally transform, which by all accounts is quite a costly exercise to do.
Yeah. While we're on the issue of SMEs, Paul, a big part of the government's initial support mechanisms or support efforts were around bringing SME tenants and landlords to the table in the retail sector. We had some good numbers yesterday from the Shopping Centre Council on negotiations and how they're progressing. More than 6,400 SME agreements in the past 7 weeks, which is running at about 150 agreements a day. So that suggests that the negotiations are on track and that SME code of conduct that was introduced is working as a good guide rail. Is that what you guys are seeing too? Are you happy with how those negotiations are going?
Look, to be truthful, I think most of the landlords have arrived kicking and screaming. I think the code of conduct's been a very smart move by the government to bring both parties together. So I think both landlord and retailer would argue that was a terrific initiative. Yep. I think we got a little complicated when it was up to the states to legislate that code. So we had different interpretations by state. But generally, I think most retailers, the majority of retailers, 60% of our members said that they've reached a good outcome with a landlord. So I think that's a positive. Always room for improvement, but it's really about speed during these times more than ever. I think when you look above $50 million, I think it's a different kettle of fish, because I think we, as retailers, would have preferred that cap wasn't set at 50. It doesn't take much to get above 50 if you're a national retailer. So working closely with the ACCC, who gave us an interim authorisation for collective bargaining, sounded great. In practice, implementation was a little bit more complicated. But I did write to each of the landlords to engage them, to at least just to discuss the framework and the principles that the larger retailers could work with. Now, when I say large, it's actually anyone above 50. So don't immediately go to the billion-dollar businesses. There's a big group in that area. So we had very mixed results. And unfortunately, this is an ongoing conversation, an ongoing discussion. Pleased to see the Shopping Centre Council release those numbers, but the majority of retailers still haven't completed a deal. So that's work to be done. And I think what this has done is actually made us reflect around how do we improve the relationship. And we've had some standouts. So Lend-Lease, particularly in Stockland, are a real standout in participating in having an open conversation and working closely with us. We've had some landlords that have actually taken the interpretation of the code because above $50 million, each landlord was asked to take the spirit of the code, where they wanted JobKeeper included as part of the income, which wasn't the purpose, or wanting to sign NDAs and asking for information that was inappropriate to get more detail around each retailer. So we've been dealing with lots of deals. I'd like to say that there were some landlords that did the right thing, and I think many that were a little tricky.
Grant, I might come to you there. You guys were one of the proponents of the code. Has it been a pretty effective set of guide rails to allow these negotiations to start?
Yeah, absolutely, James. Look, I think the key thing for the SME code in particular, from our perspective, was it set bookends and it relied upon, if you will, commercial alignment. So, in fact, I was talking to a government official in the South Australian government on Monday evening, and his comment to me was that he didn't expect such few cases of mediation being required. And the reason for that is very simple, is that both, and the government, I think to their great credit, figured out that there was a clear alignment and there was a clear need to get to a win-win. So the code actually gave the possibility for us just to get started. And nothing's perfect in life, and you can't be too prescriptive. And I think the great thing about the SME code was the timing. It happened very quickly, actually in late April. And it's therefore given us time to get our customers, meaning our tenants, set for what has been a very challenging period. So we were very much welcoming it. I just want to respond to one thing Paul said, without being too pejorative, which is that I do agree that the SME and non-SME businesses have been treated differently by landlords. I think one of the reasons for that that's very important for the people dialing in to realise is that many of the more sophisticated tenants actually come to us wanting an individual deal rather than collective bargaining. So we are actually responding to those approaches as opposed to seeking to necessarily strike a collective agreement, which of course would take time and so on. And the fundamental principle that we apply again is alignment. It's in our interests that these tenants who we value so highly and have had many long-standing relationships with survive this and come out of this in better shape than they went in. So landlords have no interest at all in actually cutting a deal which is to the detriment of the non-SME. And in fact, I'd make one other point. The landlords of Australia are one of the few groups with private capital who have actually forgiven revenue that they would otherwise have gotten. The banks, for example, have not done that. They've merely done deferrals. We are in the process of actively waiving rent. And this is a very, very important point because, and it's something that hasn't hit the public domain, in my opinion, enough, which is that our shareholders, such as Julia, are already bearing a lot of burden here because they've had, in some senses, the courage of their convictions to actually support teams such as us, which are waiving rent as we speak. And it's a really, really important point. We are not just rolling over and deferring, we are waiving. And that is providing a lot of relief to a lot of both small, medium enterprises and the larger enterprises as well.
Yeah. Grant, that's as you say, I don't think many people quite are across that there's been actual waiving of rent, not just deferral.
Yeah.
How are you sort of responding to the Premier Investments, the Solomon Lew position of not paying rent during that period or trying to move to a different rent structure? How do you sort of respond to that in a practical way?
Well, James, we never comment on individual negotiations, but I think the key point here is that, and I think to be fair to Premier, we've actually had a lot of great discussions with them of late. And of course, it's much easier for retailers once stores start to reopen. But I'd rather not talk about an individual negotiation, which is obviously governed by a very long-standing relationship, which we deeply value with that group that you mentioned. It's more about crafting a win-win. It's taking a commercial approach, which does not seek to be, in an old style of mercantilism, impoverishing somebody because they're going through a tough time. What you're really trying to do is look through on a 2 to 5 year basis when we all expect and hope that we'll be out of this and ensure that tenant base, to the maximum extent possible, is intact. And we apply that philosophy with everybody. And I'm pleased to say that almost without exception, the tenants do the same with us.
Yeah, great. Julia, what do you see as the sort of potential rent structures coming out of this? We've seen a push by Premier towards percentage rents where the rent's based on a percentage of turnover rather than a sort of the current arrangement, which is a base rent plus inflation. From an investor's perspective, you've got you're investing in businesses, the landlords, which have high fixed costs, and so a variable rent's going to be quite difficult to deal with. What do you think we might see over the next 2-3 years in this area?
Well, I think certainly in the short term, and a percentage of the rent could be based on turnover. But fundamentally, as an investor, we'd like to see a substantial amount of the rent being the base rent. I mean, I don't invest in office buildings and get a percentage of what law firms bill. I think for landlords, their job is really to generate foot traffic, and for retailers, their job is really to convert that foot traffic to sales. And I think to come out of this, with a model of just purely percentage rent is a bit idealistic. And it's extremely difficult to value, and for an asset class, it'd be very difficult to have leverage against that as well. So I think, if you're a retailer at the moment, it'd be very difficult to make long-term decisions, particularly given the amount of support in the system, fiscal support, monetary support. We're all looking to see where retail sales will settle, after the stimulus of superannuation withdrawals as well. We've also had forbearance, massive forbearance by the banks. For mortgages, we've had free childcare. So I think retailers, looking to make longer-term decisions, maybe when they've got a bit more confidence about where retail sales will settle. But I think, in the interim, you'll probably see some more holdovers, maybe a pickup in vacancy, maybe some shorter-term leases. But I think purely percentage rents really doesn't work. It doesn't work for investors.
Yeah, thanks, Julia. Ian, what are you seeing? We've got the big boss, Rob Scott, the Chief Executive of Wesfarmers, coming up soon. He's made this really good point, I think, that the retail landscape's changed so much in the last 30 years, but we haven't seen a lot of change in rent structures. What's the Kmart Group's view?
I think it's a fascinating debate, and taking Grant's direction around balance and finding an equilibrium that makes sense, I think is going to be really important. So I think one thing's for sure: the days of long-term rents that can only go up are gone. Right? None of us are going to be signing anything like that in the future, because what this period of time has told us is things can happen where where sales decline, completely outside of the control of the retailer, and rents do not. And you stand back and look at that as somebody running a company, and you just cannot have that outcome. Yeah. So I think we're going to be looking at shorter term leases, and I think inevitably we'll be looking for mechanisms where rental payments can go up and down. And that second piece is really important, because historically that's not been the case. Of course, rental agreements have generally had a fixed base with an incremental element, and in our case, with long time frames. Yeah. That creates a lot of issues, because you can end up with a store in a centre which is really not a great store. It's not great for the centre, it's not great for the retailer, and yet the lease conditions and the investment structure is forcing that store to stay open, which I think is doing long-term damage to the retailers, and I think it's also doing long-term damage to the centres.
Grant, you've got a group of negotiations going on now, which are about getting through this crisis. But I'm sure you're putting a lot of thought into what the next, what the rent structure of the future is. Are you starting to get a sense of how Vicinity might approach it?
Yeah, thanks, James. And it probably builds on both Julia's point and also Ian's. I think it's actually a combination of base rent with then some upside, perhaps associated, for example, with online. So I think we need to no longer maybe regard space as a physical construct, but regard it as a virtual construct. In other words, we attach to our physical proposition the online share of mind that we get through being the role of a showroom or being an element of the click and collect structure. Julia, though, is 100% correct. The nature of the REIT investment capital is that it wants surety of return. So there'll always be, if you will, a base load of rent that we have to underwrite and which our investors and creditors require us to do. But I think what this crisis has demonstrated is there's many new ways of thinking about how to, again, align ourselves with the tenant so that everybody wins. And I think one of those is to encourage the online business from the physical site that we historically have valued, but to capture some upside when that online business performs well, because we believe that we've clearly had a role in helping that to occur.
So perhaps that's not a shift to percentage rents, because you're using base. There's a base rent element, but there'd be some element in the sort of in the variable part that would reflect that would share where the landlord and the tenant would share the benefits of online sales as well.
Absolutely correct. And if you think about it, what it actually does is it encourages our leasing teams to be creative when they deal with a customer, with a tenant. They should be, and we certainly encourage and train them to do so, they should be thinking about how to make that customer's business more successful. And one of the ways to do that is to align the incentive structures. And as you correctly say, James, having a variable component, of the rental income to us is a way of doing it, without, of course, sacrificing the fundamental principle that we must have a base load of rent to stay in business and be profitable.
Paul, what's the feedback from your members? Obviously there'll be different views in different sizes and different sizes of business and different locations, but are you starting to get a sense of how your members want to see this shift?
Look, I think it's fair to say there's been a traditional imbalance of power, and it becomes between landlord and retail, and I guess we're trying to get some sort of equal footing. It's interesting to hear what Grant's saying. If I could just quickly respond to that, I'm not sure there'd be too many retailers that'd be agreeing to that a landlord would be taking a percentage of online sales when mostly retailers are fulfilling that product from a warehouse. So almost they'd be paying double rent, the warehouse and then the store. I think, it's we're trying to look at creative ways, but the overwhelming majority want a variable rent structure where landlords and retailers share on the upside, and they also suffer on the downside to deal with particularly unprecedented times as we're seeing right now with this pandemic.
Can I just respond to that just very quickly, James? I mean, the reality is that 2/3 of online fulfillment actually happens through click and collect. So 2/3 is happening through a shopping centre. So it's quite a legitimate debate to have with your, I think, Paul, respectfully, with your tenants.
I think, Grant, to be fair, click and collect is a separate issue to online. So I think click and collect has been collected from a store by a consumer. That inventory comes out of the store and the sale is registered at the store. I guess it's where you're talking about an online facility and actually then taking clippings. So a lot of our members have mentioned that a lot of the new leases have this online clause, and it's something that all retailers are very sensitive towards, because in many cases the online trading, because of the volume's not quite there yet, is actually more costly for a retailer to run. So I guess that's the first thing. The second element to this is just making sure that during this period, as the negotiations are continuing, the other biggest issue for retailers is outgoings. So they're finding that they're being charged with promotional levies. And, often these shopping centres were actually in darkness other than the supermarkets being open and being charged that. So I guess from a member's point of view, these things actually need to be resolved and seen more as a partnership to resolve.
Paul, just quickly, we had Michaelia Cash on before. The issue of government support post-September is obviously important. Have you got a sort of top priority? Is it extending JobKeeper, I should say, in some way to the retail sector specifically?
Look, James, we are facing a cliff come September when JobKeeper is withdrawn, when superannuation, ability to draw down on superannuation actually is also not allowed post-September. And also the code of conduct, as I understand it, from a leasing point of view, and equally the ACCC ruling all end in September. So we're up for a very COVID Christmas, I guess. And this is the all-important trading period for retailers. We move into that November, December, January trading, where Christmas, often retailers sustain that cash for the rest of the year of trading. So what we want to see is a slope rather than a cliff. And that means a more targeted approach. We understand it's not an open checkbook, but certainly a way of actually dealing with those retailers in need, which is predominantly discretionary retailers, specialty retailers, anyone in that fashion and footwear area, tourism and CBD locations, of course. So anyone that's relying on those foot traffic to trade through. So that's important. Right.
Ian, we've got you here. We should ask about the Target restructure, which was announced a couple of weeks ago in the middle of a whole lot of other things. How's it progressing? You're in the middle of store conversions, some store closures. Can you give us a little bit of an update?
Yeah, it's a business that's been troubled for quite some time, and we've been working very hard to course correct that, and we've had to take some very painful action. As the team members in Target know right now, because we're going through some of those processes at the moment. What are we trying to do? We're trying to really get back to focusing on that core proposition of style, quality at a great price, which is what Target's always had a reputation for. But we've got to find a way to get the economics to work so that business can make money while servicing those customers who really value that offer. And so what we've done is we've really tried to simplify the way that we run that business. So we're now going to run one format with one range across those stores, which will enable us to slim down the organisation, lower the costs, and hopefully get us back to a more profitable position. There's still much work to do, of course, with the team. And, I can only thank the team across all of my businesses, whilst I've got the opportunity, for the incredible work that they're doing through this period, through all the uncertainty for themselves, but the fact they've been there for customers. I think we all appreciate that as customers ourselves.
Yeah, absolutely. Julia, the next 12 to 18 months is going to be an interesting period for investors. How are you thinking about the REIT sector over that period?
It's fairly attractively priced at the moment. Obviously, you're looking at a short-term hit to earnings from downtime associated with closures. So we're trying to look through the next 6 to 12 months to see the lay of the land and where consumption and where rents will settle. We're certainly hoping that retailers and landlords come to agreement and set rents at sustainable levels so that retailer sales can grow and rents can grow from here. And so we're trying to put a value on that. It's quite, in terms of asset values, it's there wasn't a lot of price discovery booked before COVID. There's certainly none at the moment. So cap rates, which are used to value physical assets, are a bit academic, particularly compared to the very low bond rate at the moment. But what we're looking at is what sustainable rents to capitalise. So trying to make a value assessment on whether to buy particular REITs, and also looking where asset values will go and the starting point of gearing and capital structures too. So the REIT sector is priced fairly competitively at the moment. It's just getting a feel for where rents will settle in the future.
Yeah, a lot to think about. Grant, one thing Julia will be considering is how malls are used, sort of this idea of mixed use. Is that something that COVID is you've been thinking about that for some time? Has COVID accelerated that thinking process?
Yeah, absolutely, James. I mean, I think the way we think about mixed use is that it augments our retail proposition, and the retail augments the mixed use. So in other words, if it's a residential or a commercial offering, it should be additive to our retail proposition to protect, our core value proposition. And we believe that in almost all cases occurs because of more footfall, because of that additional property that you're adding to the site. And at the same time, the retail helps, for example, the residential and the commercial. And so we like to say that 1 + 1 = 3, if I can use a cliche to end on, that actually both are symbiotic and that it's an incredibly accretive and healthy way to diversify.
Well, terrific, Grant. Thank you for that. It's been a fantastic panel. There's a lot to chew over going out of this. The rent debate is one that's going to rage for a long time, but I think at least there's if nothing else, COVID's given us a sense that people are willing to come to the table and look at a different way forward. So thank you very much to our panellists today. I'll hand back to James Dagger-Nixon in our Sydney studio.